We were discussing about the concept of the depreciation. We have written that how the depreciation is calculated. We have discussed that how it is recorded in the books of the account, then how we are showing it in the books of the account. So the same thing we discussed, the building, that the cost is how much? $200,000. Then we assume that the expected life or the useful life of the asset is 20 years. And then very important thing, we assume that it has no salvage value. Salvage value is what? That at the end of the life of the asset, what will be its market value, how much it can be sold. So we assume that it has no salvage value, no scrap value, no residual value. So it is just an assumption. So for the simplicity purposes, in the later calculations, we will consider the salvage value and how it is adjusted. Okay. Then the depreciation, we said the depreciation is an expense. How it is calculated? The cost of the asset over the useful life. So it is almost $10,000 per year. So this 10,000 is what this is the depreciation per year. So now we have a concept of three things. First thing is what? That is the cost of the asset. So the cost of the asset is 200,000. Okay, and the cost of the asset is not changing. Okay, how it's not changing? Because you purchased the building in 2020 and then you will use it for the next 20 years. So it means every year the cost was same. So there is no major change in the cost. We are assuming that there is no major change in the cost because we just purchase it for 200,000 and in the next 20 years we are not making any addition to that building, or we are not making any major change in that building. So that's why we are assuming that the cost will be same for next 20 years. So it will be same for year 1 to year 20. So the cost is same, and in the books of the account the cost will be written same 200,000. Now the net book value, obviously that will be changing and it will be different every year. And how the net book value is calculated? So it is calculated the cost minus accumulated depreciation. So for year 1, year 2, year 3 up to year 20. So the cost, as we said, it is same 200,000 for year 1, for year 2, for year 3. So the cost is not changing. So the amount which you have paid in the start of the year, so for the year 20 also, so it is same. So it is same for the all, so 200,000. But accumulated depreciation for the first year, it is how much? So it is 10,000 accumulated for 1 year, 10,000. For 2 year, if you accumulate 10,000 for 1 year, 2,000, it will be 20,000. For 3 years, it will be 30,000. And obviously, at the end of the life, it will be same 200,000. All it is depreciated. So here we see it is 190,000 book value, then 180,000, 170,000, and then at the end it will be nil. So what is the meaning of this thing? The book value or the net book value of the asset is reducing every year. So in the start, the net book value when the asset was purchased, so it is same 200,000, it is in the book. But at the end of the first year, when you depreciated it for 1 year, so its value reduced from 200,000 to 190,000. Why it reduced? Because you depreciated, you allocated the cost for 1 year, so have written it as an expense. Now for the 2 year, it is depreciated for 20,000, 30,000. So every year it is reducing. If you see here, the value is reducing until it is nil. So it means after 20 years, the book value of that asset will be 0. So every year it is reducing the same value. Proportionate change is there, 10,000, 10,000, 10,000 reduction. So 10,000, 20, 30, 40 up to 200,000, that is the same. So the value will be nil after 20 years. The next concept is what? That is the concept of the market value. Now, The market value is something different. So the asset can be sold in market for how many dollars? So market is changing. The morning maybe market is different, value is different. In the evening, after 2 days, after 1 month, after 1 year, the market may be different. So market value at the start was 200,000 when you purchased the asset, when the business purchased the asset. But after 1 year, so the market value may increase. So the market value may be increasing or it may be decreasing, or it may be, for example, if we look at this like this, like these are the years are there. So the market value was this, it may be reduction, then increase, then reduce, then increase. So the market value may increase, may decrease, number of the years. So year 1, year 2, year 3, year 4, year 5, like this. But the book value, the net book value of the asset, so it will not be linked to the market value. So market value is different, the net book value is different, and the market value may increase, may decrease. But if we talk about the net book value, so it will be reduced until it will be 0. So it is reducing, and same pace it is reducing. So 10,000 every year it is reducing, 10, 20, 30, 40 up till 200,000, all is depreciated. So the asset value is nil. So that is the concept. You should understand that the cost is how much you paid when you purchased the non-current asset, the tangible non-current asset. When you purchased it, how much you have paid. The second thing is the net book value. The net book value, very simple formula is there: cost minus accumulated depreciation. And accumulated depreciation is what? It is the sum of the depreciation over the years. For 1 year it is 10,000, for 2 years 20,000. So the net book value is reducing every year until it is 0. But the third thing is the market value, that if this asset is sold in the market, in the open market, the building you can sell after 2 years, 5 years, 10 years. So how much it will be sold? But we are not writing this thing in the books of the account. We are not considering it in the books of the account that how much is the market value. We are just writing in the books the net book value. In the accounts, only important is the net book value. That is important in the accounts or in the financial statements. But this one, the market value, we are not considering it for the financial statements or for the accounting purposes. There is some possibilities that if there is some major change in the value and what you are showing in the books is different and what is in the market is different, so you may reevaluate. But it is a, you can say, a bit advanced topic. We will discuss in the next lectures or in the later lectures. Okay. Now, one more thing that is important when we talk about the cost of the asset, we have written it as a 200,000. So the cost of the asset 200,000 means that you have purchased this building for 200,000, maybe or maybe less, but the cost you are writing for 200,000. Why? Because it is not only the purchase price. It may be some like a taxes you are paying, or it may be some registration fee, okay, or it may be some commission. So all these values will be considered in the cost. So this 200,000 is the sum of all these values. Means it is not only the value of the building. So it is the value of the building plus any taxes you are paying to the government when you are buying the some of the building, some of the like a non-current asset, some of the immovable property. So what you are doing, you have to pay some tax to the government, some registration fees, because the business is registered and then this building will be registered in the name, the ownership registration will be there. So for that again you have to pay some of the fees, so that will be added. Again, you may be purchasing this through some like a property agent, or what we say, some other agents. So in that case you have to pay the commission. So the commission, the registration fee, the taxes, the purchase price. So if all this added, so that will be the cost of the asset. So when we are writing the cost of the asset, so we have to consider all these things, that how much the asset was purchased, how much you have paid as a taxes, how much paid the registration fee or any other expenses related to that, or any property agent or the any expenses for the commission you have paid. So okay, so all these will be added and it will be considered as the cost of the asset. So the cost of the asset is 200,000. The net book value is reducing every year, and the market value, we are not considering it for the accounting purposes, but it is different from the net book value. So some of the asset may be increasing even they are used, like there may be like one car that you have purchased 10 years back, but due to the market conditions now its value is more than even the cost of that car when you purchased it. Or sometimes the property is very valuable, so you purchased it for 200,000, the building is 200,000 you purchase, and after 10 year 20 year even the value is not even 200,000, it is more than that. So the market value is different, so we are not considering here the market value of the asset, so we are just considering what is the net book value of the asset, and if there is any major change we will adjust that one later on in the books of the account according to the international accounting standards or international financial reporting standards or generally accepted accounting principle. So this is what we are discussing, is the concept of the depreciation, how it is recorded, how it is calculated, and very basic straight line method we are using. In the next lectures we will consider that what are the other methods that we can use, maybe like we have a declining balance method, double declining balance method, sum of years digit methods. The different methods are there, okay, but the accounting entries will be same, the concept is same, the net book value will be calculated same. So the accounting treatment is same, only the value of the depreciation may be different. The next lectures also we will discuss that maybe you purchase this asset for next 20 years, but after 2 years you need some other building, so you may sell it and buy another one, or you may sell it for any other purposes. So how to treat that one, because after 2 year, 3 year, 4 year, if you are selling it, the book value will be different, the market value will be different, then there may be a profit on that sale, there may be some gain, or there may be some loss on the sale. So how to treat that one in the books of the accounts, then how to write it off if there is any other damages there, or any value appreciation, or even the reduction is there, major value revaluation is there. So we will discuss that one in the next lecture. I hope you have understood that one. And if there is still any doubt, if there is any question, you can ask me, you can just write me in the comments. So I will prepare the next videos according to that. Thank you so much.